Everybody tells you to own gold, but almost nobody tells you why. Is it an inflation hedge? Is it a crisis hedge? Is it a currency debasement hedge? Or a diversifier? The honest answer to all four of those questions is messier than what most people will admit. And today in this video, I want to put gold through a job interview style video. Because if you can't tell what job it's going to do in your portfolio, then you shouldn't be hiring it. If you enjoy long-term investment videos, subscribe to this channel where I post 5 videos per week on those subjects. Now let's get into the subject of this video, auditioning gold for a job interview as a part of our investment portfolio. And before we dive into that, I want to tell you why this video exists at all. Two of the most important psychologists of the last century, Daniel Kahneman and Amos Tversky, spent 50 years documenting a single, uncomfortable truth about human decision making. We are vastly more likely to buy something when other people are buying it than when evidence tells us that we should buy it. Other researchers, including Robert Cialdini, gave the phenomenon a name: social proof. It's the reason why restaurants with queues outside fill faster than the empty ones next door, even when the food is identical. It's the reason why stock trending on social media attracts more buyers regardless of the fundamentals. And it's the reason why nobody wants to be the only person at the party who didn't buy. And ultimately, it's the single most powerful force in retail investing. Now take a look at gold in 2026 this year. The price has hit more than 50 all-time highs since last year. Central banks are buying it by the ton. Poland, China, Uzbekistan are all adding hundreds of tons between them. And the queues outside the gold shops are real. I've seen them with my own eyes. People standing in line for hours to exchange money for gold. And the headlines about gold are everywhere. Your uncle has an opinion about it, your financial advisor has an opinion about it, your friends and family have opinions about it, and it's all over social media. But here's the question almost nobody is asking. What is this asset actually supposed to do in my portfolio? And that's not a rhetorical question. It's a job description. And without one, you're not investing. You're doing the more expensive version of standing in line, just like everyone else is. So today we're going to think a little bit ahead and write a job description for gold in our portfolio. The 4 roles people think about gold, and we'll interview the candidate for each one. We'll look at the actual evidence and not the brochure. And by the end of this video, you'll know whether gold deserves a seat in your portfolio. And just as importantly, you'll know which seat it sits in. Job 1, inflation hedge. The first job application is the one that you've heard 1,000 times already. Gold protects you against inflation. Let's actually examine that. The pitch is intuitive. Inflation makes paper money worthless. Gold's supply grows by only about 1.5% per year, much slower than central banks print currency. So when the dollar weakens, gold should rise. Simple, right? Well, the evidence is much messier than the pitch. Over very long horizons, 50 years, 100 years, gold has maintained its purchasing power against inflation. An ounce of gold roughly bought a fine man's suit in ancient Rome, and it roughly buys that today. That's a remarkable fact, and gold deserves credit for that. But here's the catch. Over the time horizons investors care about most, such as 5 years, 10 years, 20 years, gold's inflation hedging reliability is widely unreliable. A landmark study by Claude Erb and Campbell Harvey found that gold's correlation with inflation over multi-year periods is much weaker than the popular narrative suggests. Gold often rises when inflation is falling and falls when inflation is rising. Other studies show the relationship is regime dependent. Gold hedges inflation reliably in high inflation environments, but not in normal ones. The starkest example is the 1980s and 1990s. Inflation in the United States was meaningfully positive for 2 full decades. Gold spent those same 2 decades going down, from 850 in 1980 to 255 in 2001. And so investors who bought gold to hedge against inflation in those periods lost 70% of their money while inflation kept eroding the dollar's purchasing power. The hedge they hired to show up to work for 20 years. So is gold an inflation hedge? Well, across centuries it is, but for the average investor with, let's say, a 30-year horizon, it's a coin flip dressed as a strategy. So the verdict on job 1 is that it's unreliable. Hire only if you have a multi-decade horizon and the discipline to wait out 20-year flat periods, and most investors don't. Job 2 is the crisis hedge. The second application job protects you in a time of crisis. This one has more evidence behind it, but let's see how much. When equities crash, investors look for safe havens. Gold is one of the assets people flee to. So far, so good, right? But the data on crisis hedging specifically is a little bit more nuanced. In the 2008 financial crisis, for example, gold initially fell alongside everything else. Investors sold gold to raise cash and cover margin calls. It bottomed in October 2008 before beginning a multi-year rally. In the March 2020 COVID crash, gold did roughly the same thing. It fell sharply in the first liquidity panic, then ran to new highs afterwards. So gold isn't always a safe haven during a crisis. It's usually a safe haven after the initial panic, once the dust settles and investors start questioning the system that just broke. That's a more specific and more useful description. The strongest case for gold as a crisis hedge is geopolitical, not financial. The freezing of Russia's $300 billion in foreign reserves in 2022 sent a signal to every non-Western central bank. The dollar is yours to hold only as Washington agrees to. Within months, central gold bank purchases hit a multi-decade record. 3 consecutive years of more than 1,000 tons of net buying. That isn't speculation. That's sovereign level risk management. But, and this is the part that matters for you, that's the central bank trade. Your trade is different. You're not managing $200 billion across a portfolio that includes potential sanctions risks. You're managing a personal portfolio against the risk of, say, a 2008 recession or a regional conflict. For that job, gold has a modest track record. It typically rises after the first wave of panic, but it's not magic. Crash short duration treasuries and even certain currencies sometimes hedge crises better than gold does over short windows. So the verdict on job 2 is real but overstated. Gold is a crisis hedge with a delay. It works better for sovereigns than it does for individuals. Job 3, currency debasement hedge. The third job, gold protects you against currency debasement. Now, this is the strongest case in the entire interviews. The dollar has lost over 98% of purchasing power against gold since 1924. The pound has lost even more. The yen has lost more. Every fiat currency in history, with no exceptions, has eventually been debased through inflation, devaluation, or outright failure. The mechanism is simple. Governments expand the money supply for political reasons, to fund wars, to fund welfare, to fund interest payments, to fund themselves. And every time they do, each existing unit of currency represents a slightly smaller slice of the productive economy value. And over decades, those slices get smaller. Gold's supply, by contrast, grows about 1.5% a year. Slower than global money supply, but it always grows. So over very long periods, gold's purchasing power against currencies trends upwards. Not because gold gets more valuable, but because the currencies measuring against it get less valuable. And this is the job that gold has done very well over millennia. And it's the job that central banks are hiring it for right now. They aren't buying gold because they think inflation is going up next year. They're buying gold because they don't trust the long-term debasement trajectory of the currencies they hold reserves in. The catch, and there's always a catch, is that this trade pays off over decades and not quarters. If your investment horizon is 5 years, gold can absolutely lose ground against the dollar, even while the dollar is being debased. Currency debasement is a glacial progress. Gold's value against it asserts itself slowly, with brutal interruptions along the way. So the verdict on job 3 is a solid higher if you have the time horizon to wait it out. And this is the strongest case for gold in 2026. Job 4, portfolio diversifier. The final application. Gold makes your portfolio less volatile by being uncorrelated with stocks and bonds. This one has the cleanest evidence of all 4. The cleanest, but still modest. Gold's long-run correlation with the S&P 500 is roughly 0, sometimes slightly positive, sometimes slightly negative. Now that's actually rare and valuable. A genuinely uncorrelated asset can meaningfully reduce portfolio volatility without sacrificing much return, especially when held in modest amounts. Most academic studies suggest a 5 to 10% portfolio allocation to gold can lower portfolio volatility and improve risk-adjusted returns in a 60-40 stock-bond portfolio. That's not nothing, but notice the size of that allocation. 5 to 10%. A diversifier's job is to be a small stabilizing presence, not the main event. The mistake most retail investors make is treating either gold as a wager, that's like 50% allocation, or a religion. It's the only honest money and everything else is fake. But the actual evidence-based case is much more boring than those. Just hold a small slice, rebalance, and let it do its quiet, uncorrelated job in the background. So the verdict on job 4 is hire, but only as a part-time employee, 5 to 10% of your portfolio, no more. So here's what that 4-job interview leaves us with. As an inflation hedge, unreliable over investor relevant horizons. As a crisis hedge, real but with a delay, and stronger for sovereigns than for individuals. As a currency debasement hedge, the strongest plays off over decades, but it pays off over decades. As a diversifier, this is the cleanest evidence, but only at modest allocations. And that's the honest summary. Gold is not a scam, and it's also not a magic bullet. It's a specific asset with specific properties, and like any employee, it works best when you hire it for the suitable role and don't ask it to do jobs that it isn't qualified for. So should you own it? Well, that's up to you and based on your analysis of this video. And if you enjoy long-term investment videos like this and you're looking forward to more, please subscribe to this channel. I post at least 5 a week.